You've said that you didn't buy the Bitcoin to sell it, but would MicroStrategy ever take some off the table when you sense the market is at a top and then just buy in later when there's another correction? Or do you just plan to hodl through all the 80% downturns?
Yeah, again, I just disagree with your characterization. I don't expect an 80% downturn. I don't think it's a speculative asset. I don't think you can quote unquote take money off the table. The point is, if you have the superior asset, it's going up forever, Laura. Forever, Laura. You know, you're speaking like a crypto trader right now, right? Like, you know, in Zimbabwe, you think they would take money off the table, right? Like maybe you're doing it just to represent their interest, but I don't see the world that way. I think that Bitcoin is sound money. It's the technically superior asset class compared to the dollar, the euro, the peso, the bolivar, compared to a stock index, compared to gold, compared to silver, compared to everything you can conceivably buy. It is technically thermodynamically superior as an asset. If you have the superior asset, it's going up forever, Laura. Forever, Laura.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks ticked higher on Tuesday as investors digested a revision to US job numbers that showed further labor market weakness that could reset expectations for interest rate cuts. And despite the horrid job revisions we got, things were actually largely bullish. We did see some outperformance here from some of the big names in each sector. For example, Google, Meta, Netflix in the comm services, they rallied, and we saw mixed trade in the rest of the index. Amazon gained for the consumer cyclical index. For example, defensive saw Walmart, Costco, Coca-Cola, Pepsi outperform, relatively speaking. For example, in energy, ExxonMobil and Chevron outperformed. In fact, most of energy was really positive, along with utilities. Along with utilities, these two generally work in tandem, especially since AI. You can see here, Eli Lilly up 1%, the best performer year in healthcare, apart from some healthcare plans. United Healthcare up 9.15%. We'll talk about it a little bit later on. JP Morgan, all of the big financial center banks, Bank of America, Wells Fargo, Citi, they gained in a very big way. Morgan Stanley and Goldman Sachs were also up in a very big way. And that was really it today. A couple of the big name losers, Apple, AVGO, Nvidia was flat, Microsoft was flat. We'll talk about why and what's happening in the market there. When we look at the sector analysis, you can see things are kind of mixed now. This right here, XLRE, this is supposed to be red. I don't know why it's green. It's supposed to be red. But these sectors actually lost today. Technology, real estate, consumer discretionary, industrials, materials, very cyclical and sensitive sectors. However, the gainers in the market lifted the S&P 500 up 0.14%. And again, we continue to see that rotation, energy, utilities, healthcare, financials, comm services. These sectors are at the top, outperforming technology. And again, it's really, really good. But this is really just the large cap indices. Things took a little bit of a turn when we look at some of the small caps, some of the mid caps. We really did see a sell-off here in some of the higher beta names, especially in growth and core. Value also took it on the chin. Mid caps was kind of all right. I mean, if you look at mid cap growth, mid cap value, down 0.03 and 0.08, negligible, but core did fall. And then we did see sort of large cap value outperform. They performed the best. And then large cap growth was up 0.44% with core pretty much flat here on the day. And really the reason why we saw this type of very mixed trade had to do with economic data. Now we got the non-farm payrolls annual revision, right? This happens in September every single year. The number came in at negative 911,000. The previous number was 818,000. Now I think the market wanted about 700K. We actually don't really have a consensus figure per se. There was a lot of consensus figures, but it was a big revision. It beat last year's revision. And yeah, it just further shows labor market weakening. However, we did get the Red Book index that came in slightly more solid than expected. And the business optimism index actually came in better than expected. But really, this did cause quite a lot of volatility, especially in some of these smaller cap names. The market is saying, hey, the economy is weakening despite rate cuts. I really want to be out of higher beta. I want to be in more secure assets like large cap names. It's very, very clear and becoming clearer by the day that the labor market, the employment situation is on shakier footing. It's definitely weakening. And so we certainly need rate cuts. I think this all but assured at least a 25 basis point rate cut. And we're still sitting at about a 25 cut, upward of the 88% probabilities, looking to the FOMC, which is next week, by the way, guys. Now, some market movers, Apple was down about 1.75% year to date after its annual fall event where it showcased its newest iPhone, the iPhone 17 Air, which is an incredibly thin phone with a titanium housing. They also released the iPod, the AirPods Pro 3, the Apple Watch Series 11, and many, many more. We're going to go through some of the key things we saw right here. Now, the entry-level iPhone, the iPhone 17, is still going to be $799 with an improved display and higher refresh rate. That was a big issue with the previous iPhone. 60 hertz refresh rate for an $800 phone. Do better, Apple, and they certainly have this year. The screen is also slightly larger by an inch via decreasing the bezel size, so you're getting more for roughly the same price. The iPhone Pro got a $100 price bump, and the iPhone 17 Pro now starts at $1099. That's crazy. However, the user says it will get a 256 gigabyte storage boost, so the minimum storage now starts at 256 as opposed to 128. Apple's iPhone 17 Pro Max did not get a major update to its pricing. It remains at $1199, although Apple did add a new high-end model with 2 terabytes of storage. Very interesting. The AirPod Pro 3 have improved audio quality, noise cancellation, and one new feature is that they will be able to translate conversations in foreign languages in real time. They cost $249, the same as their predecessor. The company also released 3 new Apple Watch models called the Series 11, including updating its low-end SE and high-end Ultra models. The price didn't change. Apple added a new health feature to the devices that will use machine learning to determine if the user is at risk of high blood pressure. Also, iOS 26 will be available as a free software update on Monday with that liquid display. Very interesting. The market obviously not really liking it, down 1.75%, but all in all, we'll see if this can drum up enthusiasm to get people to go out and buy Apple products. Some other market movers, Nebius Group was up 48% after it signed a $17 billion 7-year deal with Microsoft for record before signing this deal, the stock's market cap was about $15 billion. So absolutely insane. I think the stock is probably going to go to 120, 130 before quarters end. And then the other infrastructure names rose in sympathy. Iris Energy was up 14.55%. CoreWeave was up 5.78% on the back of that news. And then for everything we saw today, there was 2,600 advances, 3,500 decliners. We saw net inflows in the New York Stock Exchange, outflows in the Nasdaq 100, the S&P 500 gaining ever so slightly. And we finally lost the 5-day. It was bound to happen. However, when we look at everything from the 20 to the 200-day moving average, market momentum is still telling us things are on really solid footing. However, the problem here is once we lose the 5-day, it normally cascades. So we'll see if September is going to continue in seasonal fashion, or if we hold our moving averages, if market momentum continues to remain sound, and if we buy the dip and then go up from here. Either way, expect fireworks over the next 6 weeks. Let's hop on the charts. Now, diving into the charts, you can clearly see large caps, mega caps outperforming in the green. The rest of the market, not so flashy. In fact, mid caps and small caps really taking it on the chin, just down shy of 1%. And again, weakening economic fundamentals, the market probably rotating into the safer assets. And that's these mega cap companies with large balance sheets, huge cash piles, low debt, instead of these high beta, highly economically sensitive assets. That tends to be mid caps and small cap stocks. Now, when we scroll down, what's very interesting is we got weak labor market data and yields actually rose. That's very, very interesting. So maybe the market was fluffing out saying, hey, we were looking for 1 million revisions. Like I said, the consensus estimates were really, really wide. There wasn't actually a consensus. The middle was about 700,000, but I saw revision estimates 1.1, 1.2 million. So it does look like the market is saying, hey, those came in better than expected. That's why yields rose. Yields only rise when the economic data is slightly better than expected, or we get into a hyperinflationary environment like we're seeing in Europe. It's really hard to determine what's happening here, but yields did rise. The dollar did rise as well, and the bonds fell. Gold fell. I mean, if the market really was worried about those revisions, wouldn't yields have fallen? Gold have ripped up? Just a very weird trade that we're seeing right now. Cryptocurrency, Bitcoin and Ethereum, we'll talk about it. Slightly red right here. Bitcoin down, Ethereum down. But again, holding very key levels. I feel like I say that every single video. And all in all, what we really just saw today was, a green day because of the mega caps, but broadly speaking, we saw a bit of weakness under the hood. And again, this just goes with typical seasonal fashion here in September. If we go to the S&P 500, hop on the daily chart, you can see things look really, really good for the S&P 500 at all-time highs, near all-time highs, making higher highs, higher lows. But if you actually just look at it in aggregate, right, pretty much what we've done for the last, I would say, 2 to 3 weeks is virtually nothing. We're just trading in a range right here. And I do expect this to continue in September. And look, we can go as low as the 6,100. We can even remake another all-time high. I just think that we are just going to trade inside a very wide range here in the month of September and for a little bit through October. This is just called a correction in time, right? You can get a correction in price, like we did right here with the tariff tantrum. You can get a correction in time, pretty much what we're seeing right here, which is just the market, sort of just trading sideways. Neither is better than the other. It's just how the market tends to work. We can see roughly the same is true for the Nasdaq 100. We haven't really done anything for the last couple of weeks, just trading inside this range and ultimately waiting for the next breakout to the upside or the downside. And it's roughly the same in all of these indices right now. I mean, the RSP did go ahead, hit new all-time highs last week, this week. However, when you look at everything in aggregate, all we're really doing for, equity markets is just sort of like trading, digesting the massive move we got off the highs right here. And yes, we are making all-time highs and we are consolidating at the top end of the range. That is constructive for us to move higher, but we are consolidating nonetheless. And the same is true for mid-cap indices. It's looking a little bit stronger in some of the mid-cap names as well as the RRUT. I mean, on Monday, we hit 52-week highs in the Russell 2000, the RSP, and the mid-cap indices. But, we're still sort of just digesting again this massive move off the lows right here. September tends to be seasonally weak. We haven't seen a lot of that seasonality, especially in the S&P 500. Yeah, we did see a little bit of a drop right here. However, we paired a lot of those losses rallying back up to all-time highs. The same is true with the Nasdaq 100. And ultimately, right, the equity markets are just telling us, hey, we need a bit of a breather after the massive rally we've had since April. Now, some of our other markets are telling us a lot different things. Gold is telling us that, with the economic fundamentals, need a bit of work. We have seen gold rally and rip to the upside. This largely has to do with Europe. I also think the US, gold being, a great safe haven and store of value. We've clearly broken above. I think we are going to get a bit of a pullback, right? I don't know if the pullback's going to take us all the way to here or here, but either way, I think we're going to pull back and continue to rip to the upside. 400 GLD or 4,000 gold is inevitable, in my opinion, in the very, very near future. Now, looking at Bitcoin, I prefer Bitcoin over gold. You can see that we are just sort of forming like a bottom right here. We have formed a bottom. I do think we go higher into the end of the year. Now, that's not to say we can't actually trade sideways. For a good 3 or 4 weeks, we can definitely do that. Trade to the lows right here, even trade to the highs right here. Either way, I do think we do go higher for Bitcoin and Ethereum as long as we stay above the key levels. And the key levels are 4,000 for the Ethereum, right? Ethereum, 4,000. We're going to go higher. For Bitcoin, I think that's just a 100,000. It's not even the 109,000. I think if we can hold this level right here, right? I think Bob's your uncle. We buy this dip and we simply move higher. And like yesterday's video, like Michael Saylor said, those who hold fiat currency as a store of value, we consider them poor. We buy assets. We buy Bitcoin. That's what we do on this channel. Let's quickly look at the 2-year yield trading at the 3.5% mark, telling us we're looking for about 100 basis points worth of cuts, a little less than yesterday that was priced into the market. Again, very weird price action year in the yield market, like just incredibly weak, weird price action. The 10-year at 4%, the dollar did gain ever so slightly. And I mean, the dollar's not actually doubling. The dollar's sort of just, again, doing what equity markets are doing, sort of just trading, basing out after a massive move to the downside. I still see quite a bit of upside here in the dollar, especially as we get rate cuts into the end of the year. I know that's contrarian, but that's how you make money in the market. You be contrarian, take the other side of the trade. Now, guys, names I do like, NBIS, you guys know about this name. I have recommended it many times below the $50 mark, and it absolutely ripped 48%. Now, I do think you could sell some really good cash secured puts on this name. You can aim for like the $75 mark right here. I don't think we're going to actually ever see it. And you can go out and get about $1.20 for that right now. If you look out to, the start of October, the 3rd of October, the 10th of October, you can collect $1.20, right? For a name that's probably going to be $130 by that time. And if you don't want, you can wait for a pullback probably to the $85 mark. If we do get there, we're going to consolidate some of this move and then go from there. But this is probably $110, $120 stock by quarter's end, but maybe even much higher by the end of the year. Long story short, this company is set to do $300 million in revenues for 2025, right? That's going to jump to about $2.5 billion next year. So that's a massive, massive move. And I think the price has to re-rate accordingly to adjust for this. Another name that I do like is Lemonade. In fact, I actually bought 1,000 shares just the other day. You could see that we are forming a higher low relative to the gap up low we have right there. And I do think we're going to go ahead, hit the $60 mark sooner rather than later. I really, really like this name. But this is a long, long duration asset, longer than usual. And then for those of you that want to be in the mega caps, what should you buy? I think you should go ahead and buy Google. Any pullbacks we do get in Google, buy those dips. I think if we get pullbacks to the 225 area right here, that is the signal for you to get long in any one of the mega cap names. I also do like Bitcoin. I do like Ethereum. I think you should have about a 1 to 2% exposure to crypto. I personally have 5%, but keep it conservative. I think that's where you should put your money as well, guys. But all in all, equity markets still look good. We're seeing a little bit of volatility. It happens in September. Ultimately, you do know the go when it comes to the S&P 500 on the weekly chart. We still look incredibly strong. Ultimately, all we're doing in this market is looking for opportunities to buy the dip, looking for explosive growth in 2026. Guys, then diving into sentiment, we continue to remain in the neutral sentiment zone right here. This is telling us the market is not incredibly cool, but the market is not overly heated as well. And this is a good thing, guys. And I do expect that we probably are going to push into the fear zone here in September and October, especially as the market continues to do its thing. And as the market tries to reassess risk, especially as it pertains to the labor market, we'll talk a bit about that a little bit later. But let's say we do push back. That is a buying opportunity. Why? Because when we look at it long term, any dip we do get in September, and on average, we actually do get a dip right here. You can see the September average return negative 0.07%. If we do get the dip, we want to be buying that dip because when we have a May, June, July, and August, that's positive, like we have here in 2025, what we can expect in the next 12 months is 6.6% return. What we can expect for the rest of the year, in other words, September, October, November, is a 6% median return. But remember, if September is down, it's really an October, November, December story. That could bring a strong move to the upside, and that move will be driven by fundamentals, because when we look at Q2 earnings, this is the latest update. We're sitting at 13.3% earnings growth, 6.4% revenue growth. Very, very solid. But where does that leave us with valuation? And yes, US valuations are elevated. If you actually look at the US 21.4 times price to earnings, 20 times, even if you exclude big tech. Yes, multiples are elevated, but you're looking at, 14, 15, mid-teens revenue growth, and that does support the valuation. And when you look at the RSP, it's trading at 17 times forward earnings. Also, when you look at the All Country World Index, Japan, and the rest of the world, excluding the US, we actually see very reasonable valuations. So if you do want to diversify your portfolio, definitely look here, but I still really do like the US. Yes, it is trading at elevated valuations, but that's what you get when you simply have the best companies in the world. However, there is a massive risk to the market right now, and that is the macro. Jobs specifically, job finding is a risk in the labor market right now. The probability of losing a job remains relatively low. However, the mean probability of finding a job, if you lose one today, plunged to 44.91%, a level never before seen in the survey right here. Furthermore, the jobs gain diffusion index across private sector is recessionary. The 5th consecutive month with fewer than half of the private sector adding jobs. And generally speaking, when we get below the zero line right here, terrible things tend to happen, as you can see in L1, 2008, 2020. Now, we did peak below right here in 2023. It was a false move. This could be a false move as well because we are trending to the upside. Nonetheless, we do need to remain cautious, especially because the unemployment rate has been ticking up here in recent months, a move from 4.1 to 4.3. And at the start of 2025, we were at the 4% mark, as you can see, moving to the 4.3 level. So the unemployment rate has moved up. So we do have to pay attention to the data. And right now, the data, inflation data, we get the PPI and core PPI numbers tomorrow. Now, we're looking for a consensus of 0.3 for both of those. I think if these come in line, the market's going to look at that favorably. If they come in cool, the market's also going to look at that favorably. But when you look at the forecast, right, the retail forecast, we're looking for slightly warmer than expected PPI figures. The institutional forecast is looking at slightly cooler figures. And then we get the main dog here on Thursday with the CPI as well as some labor market data, the initial jobless claims earnings. We just got chewy before the open on Wednesday. That's pretty much it, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button. Leave a comment for the algorithm. Cheers.